Accounting for partnership firm fundamentals. Partnership is an association between two or more persons who agree to do business and share its profits and losses. The partners act both as agents and principals of the firm. Definition. According to Section 4 of the Indian Partnership Act, 1932, partnership is the relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. A partnership, thus, is a business relationship among two or more persons to share profits and losses of the business, carried on by all or any of them acting for all. Partners, firm and firm name. The persons who have entered into a partnership with one another individually are called partners and collectively a firm. The name under which the business is carried. Nature of partnership. Partnership is a separate business entity from the accounting point of view. However, from the legal viewpoint, a partnership firm is not a separate legal entity from its partners. It means, in case the firm is bankrupt, private estates of the partners become liable to meet the deficit. Essential features or characteristics of partnership. The essential characteristics of partnership are two or more persons, agreement, business, profit sharing, business to be carried on by all or any of them acting for all. 1. Two or more persons. There must be at least two persons to form a partnership, and all such persons must be competent to contract. According to Indian Contract Act, 1872, every person except the following is competent to contract. A. Minor. B. Persons of unsound mind, and C. Persons disqualified by any law. Section 464 of the Companies Act, 2013 empowers the government. Section 464 of the Companies Act, 2013 empowers the government to prescribe maximum number of partners in a firm subject to maximum of 100. The government has prescribed maximum number of partners in a firm to be 50. Wide Rule 10 of the Companies, Miscellaneous Rules, 2014. 2. Agreement. Partnership comes into existence by an agreement, either written or oral. The agreement among the partners is the basis of their relationship, which may be for a particular venture, for a period or at will. The written agreement among the partners is known as partnership deed. Limited Liability Partnership, LLP. Limited Liability Partnership, LLP, is a business vehicle which came into existence with the enactment of Limited Liability Partnership Act, 2008. The compliance of LLP is under the Registrar of Companies. The main features of LLP are: I. Name if the LLP is approved by the Registrar of Companies. 2. LLP comes into existence by entering into an agreement by the partners which defines their respective duties and responsibilities and also their profit-sharing ratio. The agreement is then filed with the Registrar of Companies. 3. Unlike in the case of a partnership, liability of the partners is limited to the extent of their capital. 4. At least two persons should be appointed designated persons, one of whom must be a partner. LLP must file a solvency certificate with the Registrar of Companies every year. 3. Business. A partnership is formed to do a lawful business. Business includes trade, vocation and profession. 4. Profit sharing. The agreement between among the partners must be to share profits or losses of the business. It is not essential that all the partners must share losses also. There may be a provision in the partnership deed that a particular partner or partners shall not bear the losses. 5. Business can be carried on by all or any of the partners acting for all. Business of the partnership can be carried on by all the partners of by any of them acting for all the partners. In other words, partners are agents as well as the principals. As an agent, he, partner, represents other partners and thereby bounds them through his acts. As a principal, he is bound by the act of other partners. Rights of partners. 1. Every partner has the right to participate in the management of the business. 2. Every partner has the right to be consulted about the affairs of the business. 3. Every partner has the right to inspect the books of account and have a copy of it. 4. Every partner has the right to shape profits or losses with others in the agreed ratio. 5. If a partner has advanced loan, he has the right to receive interest on it at an agreed rate of interest. In case the rate on interest is not agreed upon, interest is paid at the rate provided in the Indian Partnership Act, 1932, i.e., 6% PA. 6. In case of an emergency, a partner has the right to act according to his best judgment and be indemnified for the expenses incurred by him. 7. A partner has the right not to allow the admission of a new partner. Eight. After giving proper notice, a partner has the right to retire from the firm. 9. If a partner incurs expenses on the business or he pays some money on behalf of the firm, that partner may get indemnified against these payments from the firm. Partnership deed. Partnership comes into existence by an oral or written agreement. It is better to have written agreement to avoid any dispute. This written document known as partnership deed details the terms and conditions of partnership. It is a legal document signed by all the partners and has clauses on the following. I. Description of the partners' name, description and addresses of the partners. 2. Description of the firm, name and address of the firm. 3. Principal place of business, address of the principal place of business. 4. Nature of business that the firm shall carry on. V. Commencement of partnership, date of commencement of partnership. 6. Capital contribution, the amount of capital to be contributed by each partner, whether the capital accounts shall be fixed or fluctuating. 7. Interest on capital, rate on interest, if allowed, on capital. 8. Interest on drawing, rate in interest, if to be charged, on drawings. 9. Profit sharing ratio, ratio in which profits or losses are to be shared by the partners. Kiss smiley interest on loan, rate of interest on loan by a partner to the firm. 11. Salary, amount of salary, commission, etc., if agreed to be paid. 12. Valuation of goodwill, method by which goodwill of the firm will be valued at the time of admission or retirement of a partner or at the time of that of a partner. (13) Valuation of assets, the manner in which assets of the firm shall be valued in the case of its reconstitution. 14. Settlement of account, the manner in which accounts of partners shall be settled in case of his retirement or death or dissolution of the firm. 15. Accounting period, the date on which accounts shall be closed every year. 16. Rights and duties of partners, the rights and duties of partners are defined. 17. Duration of partnership, the period of partnership, i.e., whether it is for a specified period, for a venture or at will. Importance of partnership deed. Partnership deed is an important legal document which defines relationship among the partners. It is important to have written partnership deed to avoid and settle possible disputes. It is a good evidence in the court. Provision affecting accounting treatment in the absence of partnership deed. In the absence of partnership deed, or if the partnership deed is silent, i.e., it does not have a clause in respect of the following matters, the provisions of the Indian Partnership Act, 1932 apply. Some other important provisions of the Partnership Act, 1932. I. With the consent of all the partners, a minor may be admitted for the benefits of partnership. 2. A person may be admitted as a partner either with the consent of all the existing partners or in accordance with an express agreement among the partners. 3. A partner may retire the firm either with the consent of all other partners or in accordance with an express agreement among the partners. 4. Registration of the firm is optional and not compulsory. Unless otherwise agreed by the partners, a firm is dissolved on the death of a partner. If the partners decide, an amount is transferred to reserve and the balance profit, net divisible profit, is distributed between among the partners in their profit-sharing ratio. Profit and loss appropriation account is an extension of the profit and loss account. The balance in profit and loss appropriation account is used if PD so provided. 1. To provide for interest on the capitals of partners. 2. To provide for salaries or commissions to partners. 3. To transfer part of profit to reserve. 4. To distribute profit among the partners in their profit-sharing ratio. Note: always remember that any amount payable to a partner, except interest on loan, such as interest on capital, salary, commission, etc., is an appropriation of profit. Journal entries relating to the profit and loss appropriation account. 1. Interest on capitals. 2. Interest on drawings. 3. Partner salaries commissions. 4. Transfer to reserve. 5. Transfer of credit balance, B. Features of profit and loss appropriation account. 1. It is an extension of the profit and loss account. 2. It is prepared only by the partnership firms. 3. It shows the appropriation of net profit for the accounting period. 4. The entries in this account are past, giving effect to the partnership deed and or the Indian Partnership Act, 1932. Difference between profit and loss AC. Profit and loss appropriation AC. Profit and loss account. It is prepared after trading AC. It shows the net profit earned or loss incurred during the year. This account has neither opening nor closing balance. Items debited to this account are all expenses charged against profit. The preparation of this account is not based on partnership agreement except for interest on loan from partners. While preparing this account, matching principle, i.e., revenue is matched against expenses, is followed. Profit and loss appropriation AC. It is prepared after profit and loss account. It shows appropriation of net profit. This account may have both opening and closing balances. Items debited to this account are appropriations of profit. The preparation of this account is based on partnership agreement. While preparing this account, matching principle is not. Appropriations are more than available profit. So far, we have discussed how profit is appropriated when the firm has profit more than the amount of appropriation. But it is possible that amount of appropriation is more than available profit. In such a case, the available profits are distributed in the ratio of appropriation to be made, i.e., no particular appropriation item like salary to partners' interest of capital has priority over another appropriation item. Rent paid to a partner. Rent paid to partner is a charge against the profit and not an appropriation of profit. It is, therefore, debited to profit and loss account, not to the profit and loss appropriation account, and credited to rent payable account. Special aspects of partnership accounts. Final accounts of a partnership firm are prepared following the same principles as are followed in case of a sole proprietorship firm. But there are some issues distinct from sole proprietorship firm and thus require discussion. There are 1. Partners' capital account. 2. Interest on partners' drawings. 3. Interest on partners' capitals. 4. Salary or commission to partners. 5. Interest on partners' loan to the firm and 6. Guarantee. Partners' capital accounts. 1. Partners' capital account. A separate capital account is maintained for each partner. For example, if X, Y, and Z are 3 partners in a firm, there shall be 3 capital accounts, one each for X, Y, and Z. The partner's capital account may be maintained by following any of the 2 methods. I. Fixed capital account method. 2. Fluctuating capital account method. I. Fixed capital account method. Fixed capital means capitals of the partners are fixed. When fixed capital accounts method is followed, 2 accounts, i.e., a capital account and a current account for each partner are maintained. A. Capital account. Fixed capital means that the capital remains unaltered, i.e., fixed unless additional capital is introduced or withdrawal is made from the existing capital. Thus, if fresh capital is not introduced or capital in not withdrawn, capital account of a partner will continue to show same balance year after year. B. Current account. Current account is maintained to record transactions other than introduction and withdrawal of capital such as interest on capital, interest on drawings, salary or commission to a partner, share of profits losses. As a result, the balance of current account fluctuates with every transaction with the partner. Current account of each partner is debited and credited with. Current account of each partner is debited with I. Drawing made by him. 2. Interest on drawings. 3. Share of loss. 4. Transfer of any amount to capital account permanently. Similarly, current account of each partner is credited with I. Interest on capital. 2. Salary or commission. 3. Share of profit and 4. Normally, partner's current account has a credit balance, but if a partner has drawn more than his or her share of the profits, then it will have a debit balance. The balance of the partner's capital accounts are shown on the liabilities side of the balance sheet, as that much amount is due to them. Credit balance in current account is shown in the liabilities side and debit balance on the assets side of the balance sheet. The outline of the 2 accounts maintained under the fixed capital method are Fluctuating capital accounts method. Under fluctuating capital accounts method, only one account, namely capital account, is maintained for each partner. All transactions of a partner, example, salary or commission, interest allowed on capital, drawings, interest charged on drawings, share of profit or share of loss, etc., are recorded in his capital account. As a result, balances in the capital account fluctuates with every transaction. Capital accounts having credit balances are shown on the liabilities side, while capital accounts having debit balances are shown on the assets side of the balance sheet. Fluctuating capital method is normally followed for maintaining capital accounts, and therefore, in the absence of any instruction, this method should be followed for maintain the partner's capital account.